Getting money regularly without working too hard sounds awesome, right? That's the beauty of dividend investing. It's like a plan for getting paid every month without lifting a finger. The only catch? It often takes a long time to see real benefits. But hey, what if I told you there is the fastest way to live off passive income? In today's video, we'll spill the beans on the strategies to retire early. But before we dive into the strategies, let's first try to understand dividend investing. Dividend investing. To paint a clearer picture, let's break it down. Imagine you own shares in a company. Now, when that company makes a profit, instead of using all of it for their operations or expansion, they decide to share some of that profit with their shareholders. This sharing of profits is done through regular payments called dividends. These dividends act like a consistent income stream for you as an investor, much like receiving paychecks. The beauty of this approach is that you don't have to sell your stocks to pocket these earnings. They keep coming in like clockwork. This consistent and reliable income, coupled with potential stock price appreciation, makes dividend investing a compelling choice for those looking to build wealth steadily over time. Warren Buffett, often considered one of the most successful investors of all time, has consistently championed the merits of dividend investing throughout his illustrious career. This investment strategy involves selecting stocks in companies that regularly distribute a portion of their profits to shareholders in the form of dividends. Buffett's endorsement of this approach underscores its reliability and long-term benefits. By focusing on companies with a history of consistent dividend payouts and a solid financial foundation, investors can align themselves with a strategy that has been a cornerstone of Buffett's wealth-building philosophy. Determining the amount of money required to sustain a lifestyle solely from dividends is dependent on your individual preferences and spending habits. According to the U.S. Bureau of Statistics, the average American spends around $67,000 annually, which translates to approximately $5,600 per month. However, personal spending patterns vary, so it's essential to evaluate your own financial habits and adjust this figure to align with your specific lifestyle and needs. By customizing the estimate according to your preferences, you can better plan for a sustainable income from dividends that suits your unique circumstances. Practicing frugality and conscious spending can stretch a modest investment in dividend stocks to cover your daily necessities and even allow for discretionary spending. While a larger investment can yield higher returns, aiming for a retirement income goal of $40,000 per year, as suggested in this video, may surprisingly lead to achieving financial independence sooner than expected. By being mindful of your expenses and strategically investing in dividend stocks, you may find yourself on a faster track to meeting your retirement objectives. If dividend investing feels like a slow-cooked stew, requiring time and patience, there are strategies to expedite the journey towards financial independence. Enter the speedster of the game-covered call ETFs. Think of them as the express lane to start living off dividends. These investment funds provide a unique twist by allowing investors to benefit not only from stock appreciation, but also from dividend payments and call option premiums. It's a quicker route to potentially boost income and move closer to your financial goals. Now we understood dividend investing. Let's jump into the strategies. Strategy 1: Covered Call. ETFs, covered call. ETFs are like a special kind of investment tool. They help you make money from both growing stock values and regular dividends. Think of it as a double deal. The ETF invests in stocks but also does something extra. It writes call options on those stocks, earning extra money called premium. Now, call options are like a special pass. They let someone buy a stock at a fixed price for a set time. When the ETF sells these call options, it gets premium money, which is shared out as dividends. Plus, if the stock prices go up and the call options hit the jackpot, there might be some extra profits when the ETF sells those stocks. Consider incorporating QYLD, XYLD, and RID into your investment mix when it comes to covered call ETFs. These funds stand out as notable choices, boasting attractive yields in the double digits. To break down the numbers, over the past 12 months, QYLD demonstrated a 15.96% yield, XYLD exhibited a 14.18% yield, and RYD displayed a 13.76%. Covered call ETFs, exemplified by QYLD, XYLD, and RYD, present a distinctive advantage by providing income through both dividends and option premiums. This dual income feature enhances the dependability and stability of the passive income stream. Yet, it's essential to tread carefully, as these ETFs carry inherent risks. Options may expire worthless, and fluctuations in stock prices can impact overall returns. Investors should weigh these factors when considering covered call ETFs as part of their investment strategy. Okay, let's crunch some numbers. If your target is an annual income of $40,000 through covered call ETFs, you'd need to invest between $250,000 and $290,000, given the current yield levels. This compares favorably to traditional dividend stocks, where you'd have to invest approximately $2 million to generate a similar income. The appeal of covered call ETFs lies in their potential to offer substantial returns with a significantly lower investment requirement compared to conventional dividend stocks. Strategy 2. REITs. In order to accelerate towards a retirement funded by dividends, consider high-yield real estate investment trusts, REITs. These entities invest in income-generating real estate, spanning shopping malls, office spaces, and apartment buildings. The appeal lies in their tendency to distribute a significant portion of earnings as dividends to shareholders, creating an attractive avenue for passive income. However, it's vital to acknowledge that, like any investment, REITs come with risks, especially during economic downturns that may impact real estate values and rental incomes. Diving deeper into the world of real estate investment trusts, REITs, it's worth noting the consistent dividend performance of key players like Blue Rock Residential, Apollo Commercial, and Omega Healthcare. These REITs have established themselves as reliable choices for investors seeking regular and growing dividend payments. Over the past 20 years, the broader landscape of U.S. REITs, as highlighted by CBRE Investment Management, has demonstrated an impressive average annual return of 10.8%. This sustained financial performance underscores the enduring appeal of REITs as an investment avenue for those aiming for long-term financial stability. According to CBRE Investments, U.S. real estate investment trusts, REITs, have delivered an average annual return of 10.8% over the last 2 decades. It's crucial to recognize that these yields may vary due to factors such as occupancy rates and the overall economic climate. While investing in REITs provides the benefit of higher yields compared to traditional stocks, it comes with increased risk, especially during economic downturns when these companies are more vulnerable to market impacts. Investors should consider these factors when incorporating REITs into their investment strategy. Determining the investment needed to retire with real estate investment trusts, REITs, involves assessing the targeted annual income. If the aim is to generate $40,000 per year from REITs, a rough estimate for the required investment would be around $400,000. It's important to emphasize that this calculation is based on an average yield of 10.8%. The actual amount may fluctuate depending on variables like diversification across multiple REITs or concentrating investments in a single entity. Creating a reliable route to retirement with real estate investment trusts, REITs, involves implementing a practical and systematic investment approach. Consider committing to a regular routine where you contribute a fixed amount to your REIT portfolio each week. This disciplined strategy goes hand in hand with reinvesting the dividends generated by your investments, allowing your portfolio to gradually expand over time. While the specific time frame for achieving financial independence through this method may differ from person to person, maintaining patience and discipline could make it achievable within a relatively short span, potentially in the range of 5 to 7 years. Having a well-defined plan is essential when embarking on a dividend investing journey. Clearly outline your financial goals and determine the exact amount of money you require. This strategic approach will aid in selecting suitable stocks for your portfolio and ensuring adherence to your plan over time. Calculate your living expenses meticulously to guarantee that your investments yield enough income to meet your financial needs. Whether your lifestyle demands less than $40,000 or more, what's your view? Are covered call ETFs catching your interest? Or do you find REITs more intriguing? Share your views in the comments section below. As always, I trust you gleaned insights from today's video, and I eagerly await to connect with you in the next.